All right, welcome to This Explainer. I'm your host and subject specialist, and today we are diving straight into the ultimate A-star mentoring session. We're targeting a really challenging area of the IGCSE Accounting 0452 syllabus, Suspense Accounts Profit Adjustment. Now, I want you to think of a suspense account not just as a simple mistake, but basically as a financial quarantine zone. It's where unbalanced, sick data goes until you have the investigative skills to diagnose and fix it. We're going to elevate your understanding from basic data entry right up to high-level financial intelligence. So let's get started. To keep us on track and manage cognitive load, here is our roadmap for today. We'll cover the conceptual architecture, technical execution, AO3 interpretation, and finally, examiner insights and pitfalls. Let's move right into Section 1, the conceptual architecture. Okay, so first things first. The newly updated 2028 to 2030 syllabus mandates a strict transition to modern international terminology. What does that mean for you? It means you absolutely must use terms like irrecoverable debts instead of the old bad debts, and you have to use owner's equity flawlessly. The examiner is looking for literally 100% accuracy here. Look, using outdated terminology signals that your foundation is kind of shaky before they've even looked at your math. It's an immediate red flag that you aren't operating at that A-star tier, and we definitely want to avoid that. Assets equals liabilities plus equity. We all know it, but this isn't just some formula to memorize. It is the architectural framework of the entire business entity. Think about it. If assets don't equal liabilities plus equity, your building is leaning. A suspense account essentially acts as temporary scaffolding, holding the whole building up until you find that missing brick. Maintaining this exact equation during the fiscal period, regardless of whatever adjustments you make, is your core architectural requirement. Because if your profit adjustment throws this equation out of balance, well, your foundation just collapsed.
We also have to remember the prudence concept, right alongside the historical cost principle. Overstating profits by ignoring potential losses is a massive violation of this rule. When you're fixing errors in suspense accounts, applying prudence is non-negotiable. Now, here's a quick memory hack for you to use under exam pressure. Think of the acronym CPR, consistency, prudence, realization. If your adjustment violates CPR, your profit is artificial. You're not just memorizing vocabulary like accrued or prepaid. You need to actually apply these CPR concepts to the complex, multi-layered business scenarios you're going to face.
All right, moving on to Section 2, technical execution. Every single correction of an error starts at the source. Whether it's an invoice, a credit note, or a bank statement, that document drives the books of prime entry, which then flow into the T accounts, the trial balance, and finally the financial statements. As an A-star candidate, you really need to develop those practical investigative skills. When you're tracing an error, you must follow this procedural flow backward, almost like a detective. Trial balance is off. Check the ledger balances. Ledger is fine, interrogate the prime entry books. You simply cannot jump straight to the end without showing exactly how the data flowed through this pipeline. This brings us to something absolutely crucial, the method mark strategy. Let's work through a complex multi-step scenario. Imagine you have to correct a depreciation error that also impacts the suspense account. Let's say under exam pressure you miscalculate the reducing balance percentage, so your final mathematical number is just wrong. But if you clearly write out your workings, show the subtraction of accumulated depreciation, and post that incorrect figure to the correct debit side of the income statement and credit side of the provision account, you will still secure top method marks. Please do not do the math entirely in your head. Show your logic. Your visible methodology acts as a literal insurance policy against mathematical slip-ups. Now, as you're documenting those workings, you've got to watch out for mathematical pitfalls. A massive trap for students is the miscalculation between trade discounts and cash discounts. Let's make this concrete. Trade discounts are bulk reductions applied immediately, right? They're deducted before you even enter the transaction into the books of prime entry. Cash discounts, however, happen later as an incentive for early payment, and those must be recorded in the discount columns of the cash book and the general ledger. If you accidentally apply a trade discount in the ledger, like a cash discount, your profit adjustment will be fundamentally flawed, and that suspense account is going to remain stuck open.
And speaking of the ledger, mastering the gold standard T account structure means flawlessly distinguishing your balance B/D, balance brought down, from your balance C/D, balance carried down. This is the very heartbeat of the double entry system. You want to achieve 100% trial balance accuracy, right? Mixing up your brought down and carried down balances during a high-pressure exam is a surefire way to create a suspense account problem where absolutely none existed before. It's a completely unforced error that just bleeds critical marks.
Shifting gears now, let's look at Section 3, AO3 Interpretation.
Calculating the numbers is literally just the baseline. Interpretation is the real goal here. Say your current ratio drops drastically from a healthy 2.5 to 1 down to a really risky 1.1 to 1. An A-star candidate doesn't just state the drop, they debate the cause and effect chains. What if an unresolved suspense error falsely inflated the current assets last year, meaning the ratio was always poor? Or, perhaps inventory has been overpurchased, locking up cash. Is there a slow settlement of trade payables? You must provide the analytical why behind the numbers, linking your suspense corrections directly to their real-world impact on liquidity.
Now, directly comparing different firms, that's tricky because businesses use differing policies. For example, one firm might use the straight-line method of depreciation, while a competitor uses the reducing balance method. You have to look way beyond the surface numbers on the financial statements to analyze the true quality of the profit being reported. A higher profit might just be the result of a much less aggressive depreciation policy, not necessarily better operational performance. Your job as an analyst is to normalize these differences to find the truth.
What's really fascinating here is that long-term sustainability actually relies heavily on factors that are nowhere to be found in those accounting records we just meticulously balanced. When you're evaluating a business's return on capital employed, or ROCE, you absolutely must consider non-financial factors. We're talking about staff morale, the physical location of the business, its overarching market reputation. A company might show a brilliant profit adjustment on paper, but if staff turnover is massive and the brand is totally damaged, that ROCE just isn't sustainable. These qualitative elements are vital for survival.
Finally, we arrive at Section 4, Examiner Insights and Pitfalls.
Let me put on my senior examiner hat for just a second, because I want to give you some exclusive insider knowledge straight from the 2024 and 2025 Principal Examiner reports. It sounds incredibly basic, but guys, students constantly lose marks through poor handwriting and ledger accounts. Literally, if I cannot read your numbers, I cannot award you those precious method marks. Secondly, a really critical pitfall is failing to distinguish between revenue and capital items. Let me give you a clear example. Treating the purchase of a brand new van engine as a routine repair expense. That single error misclassifies an asset as an expense, which radically distorts your profit adjustment and completely fails the prudence concept we talked about earlier.
To put all of this into a modern industry context, think about AI-driven accounting platforms like Xero. Even with advanced fintech automating the data entry, these systems still rely completely on the transparency and integrity of human oversight. AI is brilliant at balancing data rapidly, sure, but if a human incorrectly inputs a capital expenditure as a revenue expense, well, Xero will simply balance a lie. Interested parties like banks, owners, and tax authorities are making million-dollar decisions based on these figures. AI doesn't change the accounting equation, it just processes it faster, which actually makes your human ability to interpret and adjust profits more vital than ever before.
So, I'm going to leave you with this pause and think A-star challenge to really test your high-level financial intelligence. Think back to the procedural flow we mapped out. How do automated platforms actually handle suspense account corrections compared to manual ledger adjustments? Does the underlying requirement for prudence and exact double-entry duality change when a computer does it? Or is human evaluation via AO3 more important now than it ever was? Ponder that as you review your notes. Thank you so much for joining this explainer, and keep aiming for that A-star.